Good morning, everybody. Today is just a brief presentation about the dark clouds and silver linings over the markets. And this is in view of Saturday's investment conference. So this is technically the backup presentation. Let's kick off. The dark clouds and silver linings over the major markets. Here's my brief contact details. Here's the usual disclaimer. Bit of background about myself. And the main topic for today's presentation. Okay, the dark clouds and silver linings over the major markets. The agenda for today is very much a quantimental analysis approach, whereby the first part of the presentation will go towards fundamental analysis. I'm looking in particular at the valuations of the S&P 500 in detail, and then just briefly touching on the world markets. With respect to the limited time. The second part of the presentation will be technical analysis and using Ichimoku clouds. And I'm going to start with the S&P 500, the Dow, the NASDAQ from an Ichimoku cloud chart perspective, then branching off to the UK's FTSE 100, touching on the DAX and then the Stock 600, which pretty much sums up most of Europe's large cap, 80% of the European market in the EU in particularly. Okay. So what are the dark clouds and what am I worried about? I am worried about decelerating growth in S&P 500 earnings and S&P 500 market valuations. Okay, those are the fundamental things that I'm currently worried about. Let's start with the S&P 500 index, and we look at the market, the index from a balance sheet and income statement perspective, and particularly the income statement. Where has been the revenue trends? The year-over-year quarterly growth in revenue has actually been declining pretty significantly. We can see third quarter 2016, this is about 70%, 80% of the companies already reported. We're looking at a downturn of 7.3% in top line earnings growth. Okay, so that's a decline. Last year was 2.2, and the year before was barely any growth at 0.78. So you can actually see for the last, 5 years, 1, 2, 3, 4 years, on a trailing basis, we've not had any top line growth in the S&P 500 stocks. Okay. If we look at the next line is what's been happening on the operating income growth. There we can see tremendous decline here in third quarter 2015 of minus 51%. Fourth quarter is minus 34. So it's coming from it's recovering over the last 3 years, but still overall year-over-year decline. And then the second quarter 2016, we had a positive turn, and then we've now got a deceleration again of third quarter 2016 of 3.97%. Okay, so once again, operating income growth picture not looking too good. Last quarter was a better one than the current one, and it's going to be interesting to see what the next quarter, Q4 of this year, is going to be like. Now, if we look at the operating income from continued operations, and we compare that to the operating income that they stated as reported. So that will show you lots of disparity between non-cash items and share options. So that's where the financial accounting comes into play. So you can remember the previous figures where we saw the big bath that the market took was rapid deceleration and growth. Here, the year-over-year growth of continued operations, the decline there was pretty much more or less the same in third quarter 2015, and in the fourth quarter also a little bit worse, but the reported figure wasn't that worse. And here you can start seeing the financial accounting and the options and all those creative accountancy items taking place, because despite the positive figure of the last 2 quarters on a year-over-year basis, the year-over-year quarterly growth from continued operations still shows a decline. So we have decelerating growth. We've had no growth on a operating income from continued operations basis. Okay, and that's absolutely critical to understand. The next one is net income. Cleaner figure. Net income growth, also a pretty bad picture. Okay, in terms of the S&P. All right, so that's not a very good picture. So anybody that's following the news would see none of this is really out there. Everybody's worried about this and that, macro pictures. But on a fundamental basis, the growth is vaporized. There is just no growth coming through. Okay. Earnings per share from continued operations, horrifying figures there. Okay, that looks absolutely terrible on an earnings per share basis. All right, so that's where you take into account after all the dilutions and things like that. Not a pretty picture. CapEx, are companies spending to reinvest? CapEx figure also show that Q1 of 2016 was down 15%. Second quarter of 2016 was only the time where they started spending on CapEx, and then the third quarter of 2016 this year-over-year CapEx quarterly growth is down once again, another negative figure. So it feels like the market's kind of churning because the fundamentals is just not there. And the most important figure is free cash flow growth. You can see the companies are chucking off a lot of cash. So we're not reinvesting on the one side. There's no top line growth, so they just keep scooping the free cash flow generated by continued operations. That's been growing aggressively. All right. So that's the at least the one silver lining. Management effectiveness, return on assets and return on equity. Yeah, we're looking at 5.7 for the third quarter, 1.1 the previous one. The return quarterly, this is an annual figure, runs every quarter on an annualized basis. And we can see not very good. The return on assets is not very good. However, the return on equity is a little bit better. For the third quarter of 2016, it's 19, almost 20%, which is a fantastic figure. So we can see very good return on equity generated. We can also see the growth in free cash flows come through on that. So that's excellent. But overall, the historical figures is not so good. Okay, very low return on equity in terms of the S&P 500, less than 5-6%. Third quarter of 2015 was about 9.3%. So that is also a factor to remember. Then now let's go take a look at valuations. We start with the top line, price to sales ratio. Price to sales ratio gives you an idea how expensive a company is on a sales basis. If it happens to be not profitable, 1.8, and we can see we're a little bit at the upper end of the range. We've now at the same value, roughly a little bit more expensive the fourth quarter of 2015, cheaper than it was third quarter of 15, but we are at the upper end of a price to sales ratio. So if anybody are used to running a business and you want to know how much it's worth, you can slap on a market PE, market price to sales ratio 1.8 times sales, and then you know what your net worth is, roughly. Okay. Price earnings ratio, where we look at the bottom line of the income statement, PE. There we're running at a 12-month trailing PE of 20 times earnings. That's quite the upper end of the range once again. A little bit cheaper than some of the other quarters. Third quarter of 2015 was slightly cheaper than where we are now. And second quarter of 2016, we've now seen that re-rating in the market taking place as it adjusts to the lower price earnings multiple. Okay. Price to book ratio, 3.64. Very, very expensive market at the moment. Price to book ratio, much, much more expensive than any of the other periods of time. So we can see that adjustment taking place in the market now on a price to book ratio basis. Okay. Price to free cash flow ratio, there once again, 8.69. 8.4, 8.79. So it is within a historical range. It was much, much more expensive on the price to free cash flow of the third quarter of 2015 because it was still digesting 2014's bad figures. But still, we are looking for relatively fairly priced around these price to cash flow ratios. Okay, so now we've seen the cash flow, the free cash flow generated has been catching up with the earnings. We've had no top line growth, no EBITDA growth really. And now we have this valuation on a free cash flow basis. So it looks like the market's starting to fully price in all possible angles of the fundamentals. Okay. So just looking forward, just as a summary, PE 22 times, 3.4, 1.78 price of sales, 8.61. This is current third quarter ratio. Fairly expensive on the from a market side. One silver lining, however, earnings growth, first quarter year-over-year, currently was 1.6%. So we've seen a reacceleration slightly in the expected earnings. The S&P 500 earnings per share forward estimate, based on historical data, is current level of 32.1, 32.69. Last quarter was up to 29.45 1 year ago. This is a change of 2.6% from the last quarter and 10% from 1 year ago. Okay. The actual earnings per share as reported. Hey, so that's a so as we're looking forward, so the market's expecting a 10% pop in earnings, which is doable, but considering the macroeconomic picture right now, we're not entirely sure where that growth is going to come from. So the market might be a little bit enthusiastic here, because the 12-month forward PE ratio is 14.916, and it's above the 5-year average of 14.9 and the 10-year average of 14.3. Okay, so we are expensive going into the fourth quarter of 2016. Once again, analyst estimates here, looking out on the S&P earnings, very, very enthusiastic, very bullish here. We've not seen this type of steep increase in earnings. So they are expecting something, they're working something in their numbers. Now, however, what I don't have in here is the most accurate analyst estimates. It's not stripped out yet, so we don't know. But it looks like an over-optimistic scenario to me. Okay. In terms of sectors, we're quickly going to look at some of the sectors here. The growth here, if we look at the sectors that's had the biggest year-over-year revenue growth here, was discretionary, conglomerates, financial sector here, utilities and retail. Sequential growth is the quarter, that's also picking up. Year-over-year net income growth is capital goods, 40%. Conglomerates, 14, 25, the consumer discretionary sector. So you can see there are sectors that's really suffering, non-cyclical. Human healthcare sector actually up 14, and transportation sector down 47. So that's not very good from a growth rate perspective. Profitability by sector within total market. Yeah, we can see the return on equity is very, very important here. Sectors non-cyclical, generating high return on equity. Consumer discretion 24, conglomerates 26, capital goods 20, technology 24, transportation. So these are the sectors generally generating good, healthy returns. Okay. Sector market valuations. You can see those sectors where the returns are is really fairly priced already. So we could see a correction like technology 4.3, healthcare 5.3, capital goods 4.82. Okay, and then retail 9.45. All right. Okay. Just to look at things in a little bit perspective, if we look at the historical PE going back, the historic one's 22 at the moment, but this is a quarterly data, so it runs from 24, September quarter. You can see we are really, really at the upper end of a very, very long historical range. So we either need for PE to multiple to stabilize or become cheaper. The price, the earnings need to go up, and the price needs to go down. Okay, so the higher the price, the higher the PE ratio, if the earnings become smaller and smaller and smaller. Right, so that's the dark clouds. If we look at the UK market, is expensive on a price to book ratio 1.8. It's above the 5-year average, and the current PE is 15. And that's also above the 5.8 of the other market. Okay. Overall markets are expensive. The EU and the UK, 1.5, 8. This is just third quarter data. 12-month forward estimates. There we're looking at 9.2. So even on a forward basis, the UK market, for example, looks a little bit pricey. Okay, price to sales of 1.3 is not too bad, but on a price to cash flow basis, yeah, we can see a little bit on the pricey side. Okay. So the next stop would be the technical analysis of the clouds using Ichimoku cloud chart analysis. And that will be the next part B of this recording. Thank you.